Hey everyone, welcome back to the channel. Right now, there's a low hum of anxiety spreading through the financial world. It's a feeling many of us remember, a sense that something big is brewing beneath the surface of the record-high stock markets. And the big question everyone is asking is, are we on the verge of the mother of all crashes in 2026? Today, I'm going to do something a little different. Instead of looking at one single topic, I'm going to consolidate some of the most significant macroeconomic changes happening right now in 2025. We're talking about everything from the US dollar's strange behavior to the AI frenzy that's dominating the headlines. My goal is to give you clarity and help you decide whether you should be saving cash right now, or if this is a time to be bold. So let's jump right in. The Benner's chart, a historical warning. Let's start with a piece of history that has some people very worried. This is the Benner's chart, a fascinating piece of market forecasting created over 100 years ago by a farmer named Samuel Benner. He observed cycles in the market and, based on historical patterns, created a forecast that has been eerily accurate. His chart divides time into 3 phases: panic years, good times, and hard times. He even pinpointed specific years for these events. And what's remarkable is how many historical crashes have fallen right on his predicted panic years. Think of the 1929 Great Crash, the market downturns of the 1940s, and even the 1999 dot-com bubble. Now look at where his chart points next. It indicates that we are nearing a hard times or a panic phase around 2026. This chart, which has a track record of being fairly accurate, is a major reason why some analysts are ringing the alarm bells for a potential crash. While it's just a historical model and not a crystal ball, it's a sobering reminder that market cycles are real. The AI bubble, dot-com 2.0. Next, let's talk about the AI boom. No one can deny that AI is a transformative technology. It's changing industries and creating unprecedented value. But many are now asking, is this a genuine revolution or the next dot-com bubble? During the late 90s, the internet was going to change everything, and it did. But irrational exuberance drove the valuations of countless unprofitable companies into the stratosphere. Then the bubble burst, wiping out trillions of dollars. Today, we see similar signs. AI startups with little to no revenue are being valued in the billions. Companies are pouring unimaginable amounts of money into AI infrastructure. The market is hyper-focused on a handful of Magnificent Seven stocks. The promise is real, but are the valuations sustainable? The fear is that if the lofty expectations of AI's profitability don't materialize fast enough, or if the technology's real-world applications are slower to be adopted than predicted, the entire market could face a sharp correction, just like it did in 2000. It's a classic tale of a groundbreaking technology meeting an overhyped market. The debt crisis, America's ticking time bomb. Now, let's get into what many believe is the primary fuel for this potential fire: the global debt bubble. The U.S. national debt has been on an unsustainable path for years, and it's getting worse. This isn't just a political issue, it's a core economic one. When a country's debt-to-GDP ratio gets too high, it signals a massive burden on future generations and can lead to a loss of faith in the currency. The problem is twofold. First, this debt has been funded by printing money, a move that can devalue the currency and stoke inflation. Second, as interest rates rise, the cost of servicing this debt skyrockets, leaving less money for things like infrastructure, social programs, and even defense. The U.S. government is now spending more on interest payments than it does on defense. That's a staggering fact. This debt is a major factor in why some people are predicting a crash. When markets lose confidence in a government's ability to manage its finances, a sudden and severe crisis becomes a very real possibility. It's a house of cards, and a single gust of wind, like a sudden economic downturn, could bring it all down. The de-dollarization threat and the rise of BRICS. The U.S. dollar's dominance as the world's reserve currency has been a cornerstone of global finance for decades. But that's changing. The U.S. dollar is showing signs of depreciation, and this has huge implications for the stock market. A weaker dollar can make U.S. exports more competitive, which is good for some companies. However, it can also lead to higher import costs, fueling domestic inflation. And more importantly, it signals a potential shift away from the dollar's global power. This is where the BRICS organization comes in. BRICS, Brazil, Russia, India, China, and South Africa, is actively working to challenge the dollar's hegemony. India, in particular, is a key player, pushing for local currency trade and strengthening the BRICS bloc. With the recent addition of new members like Saudi Arabia, Iran, and the UAE, the group now controls a significant portion of the world's oil and a much larger share of global GDP. They are exploring alternative payment systems and even discussing a new common currency. If this de-dollarization trend accelerates, it could diminish the global demand for U.S. dollars and U.S. debt, potentially leading to higher inflation and borrowing costs in the U.S., and a major shock to the financial system. The takeaway: should you be saving cash? So, with all these factors converging, a historic cycle prediction, a potential AI bubble, a spiraling debt crisis, and a challenge to the dollar, the question remains: should you be saving cash right now? This isn't about telling you what to do. It's about giving you clarity. The key takeaway from all of this is not to panic, but to prepare. Saving cash. In an environment of high uncertainty, holding a larger-than-normal cash position can be a smart move. It's a defensive play. It gives you a safety net and provides the liquidity to act when opportunities arise during a downturn. If a crash were to happen, the people with cash on the sidelines are the ones who can buy assets at a steep discount. Diversification. The old wisdom holds true. Don't put all your eggs in one basket. Diversify not just within sectors but also geographically. Consider international markets and look beyond just stocks. Bonds, commodities, and even real estate can act as a buffer against market volatility. Focus on value. In a frothy market, it's easy to get caught up in the hype. Instead of chasing the next big thing, focus on companies with strong fundamentals, good balance sheets, and consistent profitability. These are the companies that can weather a storm. Let me be clear, I'm not here to predict the future. No one can. But what we can do is analyze the data, understand the risks, and prepare for different scenarios. The macro changes we're seeing right now in 2025 are significant. Whether they lead to a full-blown crash in 2026 or a series of sharp corrections, the underlying forces of debt, de-dollarization, and speculative bubbles are very real. This is not a time for fear, but for informed decision-making. Be diligent, be patient, and be ready. What are your thoughts on these macroeconomic shifts? Do you think a crash is coming, or are these just growing pains? Let me know in the comments below. And if you found this video helpful, please give it a thumbs up and subscribe for more in-depth analysis. Thanks for watching, and I'll see you in the next video.